What's up, traders? Anthony Crudele here, and welcome to this week's episode of Develop Your Edge. In today's show, we'll be speaking with Ira Harris on how context and nuance are Ira's edges in his trading. And in my final thoughts, we're going to go to the charts, where I'm going to share with you my process for a gold swing position that I'm currently looking at. But before we get Ira on the line, let's come over to this screen. I'm a big believer in learning about your products before you begin to trade them. And I talked about how gold is a market I'm looking at right now. I don't day trade gold. I do a lot of swing positions in gold. And now that we have micro gold futures, I'm actually going to be using the micro gold futures for this position because my range of execution is so wide. I like to use the micros for this. So you can go to activetrader.cmegroup.com, search the product that you're potentially looking to be trading, and there's a ton of great information on there. All right, traders, hang tight while we get Ira on the line. Ira, what's going on, my friend?
Oh, Anthony, there's so much going on. It's supposed to be August. We're supposed to be sleeping and taking a rest. There is no rest for the very weary. And I mean, of course, the people on the front lines of the pandemic are the most wary. But from traders and investors, it's been a roller coaster ride of major proportions.
Before we even get into talking about markets and your edge today, you got to tell everybody about this hat and this outfit you got going on today.
Well, I'm wearing the hat, the pink hat guy, who's the guy who always sits when there are actually fandom in Wrigley Field. He's always on camera. He sits right behind home plate. He's had those 4 seats. I happen to know him. And so he gives out these hats, because that's what he's known at. He's always worn a pink hat. So they did a documentary on him, actually called The Pink Hat Guy. So I was out walking the dogs and I had this on with my pink mask. I don't want to mask myself. I have a better face for radio, of course, than television, but here we are.
Here we are. All right. Now, you and I have talked so many times over the years. I've gotten to know you extremely well. And although I know what your edge is as a trader, I never really outright just asked you the question, what do you believe your edge is as a trader?
Well, I'm going to quote our buddy Pax, Matt Canna, and he'll say, because he really put these words into my mind, my edge is the context of markets and the nuance of markets. That's my edge. And where did I develop that edge? As I talked about when we did with Kashal last year, we talked about it. It's my ability and desire to work. I always believe I'll work anybody because I have to. I don't have a team. I have me and a bunch of, actually the blog was great because I would get so much pushback and feedback, from you, and that all helps. So, but it's creating that context. I understand the context of the markets. I do. That's my strength. And then when there's little bits that show up and I can see the nuance in them, that's my greatest edge in them all.
Well, let's run with that. Where are we right now? What edges are you seeing in the market today?
Well, we did have, really the last podcast we did, I think we talked about the metals, but I've talked about the metals for a long time, and the dollar. And I was telling you that I was a lone wolf out there being as bearish as the dollar as I was. The metals were, of course, performing very well, as we've looked about, always against the other currencies.
Yeah.
But this was now a dollar play, and it was the weakening dollar that took the gold up to its all-time highs. So that was what we saw through Nuance. And in fact, I was citing my breakaway from the dollar. My bearishness of the dollar came on May 25th, as I said it, when Wolfgang Schäuble, who's a very powerful voice in Germany, pivoted from being Mr. Nine, Mr. No, as they call him, when it came to fiscal stimulus, and agreeing to create basically a Euro bond and giving out grants to the entire Europe to try to soften the impact of the pandemic. I said, that is a major pivot. And so that's a bit of nuance. That's my nuance. I read that. I had to read it again, and it was Memorial Day weekend.
Yep.
And I started buying the euro that Monday morning.
So you've been bearish the dollar this year, bullish gold. You talked about how you were bullish the euro, got long the euro. What positions do you have on right now?
Right now, today, as of today, and it could change in a minute, but I'm looking at the yen in a very important fashion because everybody's been bearish the yen. In fact, the yen is really performed poorly because it's been the euro that has taken off. So the euro yen has rallied dramatically. The yen has really stagnated here. But now here's another little bit of nuance. On Tuesday night, Wednesday, the Japanese came out with Wednesday night, I should say, came out with their PPI. Their PPI was down 0.9%. The US PPI number came out the day before. They were up far more than expected, 0.5 and 0.6. And then CPI came out Wednesday morning, and that was up much bigger than expected. Now, these are one-off, of course, and I'm not giving much because I know what the Fed is. Well, we've been told where the Fed really is going to go here. So that's part of the nuance that we're looking at. But from a real yield perspective, the yen is a much better currency, probably than them all. But we're getting some unwinding, and everybody's afraid of the Bank of Japan doing this. But from when you factor in inflation to where interest rates are, I argue that the yen is probably the best of all currencies right now on a real yield basis. So that's what I'm looking at. I want to see if it can. It's had a miserable week. The yen is weak, has been very weak this week as euro yen has rallied quite a bit as the euro has got some new strength to it. But we'll be patient here. But I'd like to see the yen close very strong today. When I say very strong, I would say in cash terms, well, let me put it in futures terms, over 94.10 in the September yen futures would be a very good close for me today. So I'm watching. If I don't get it, I won't stay long this position. I'll wait until Sunday night, Monday.
I want to go back to the dollar, gold, and euro trades. We've seen the gold and silver retrace a little bit now. Dollar still stays relatively weak, not much of a bounce back. Do you think that those trades are over? What are your thoughts on them, where they sit right now?
No, and yesterday it's a great question that you asked because I read a Project Syndicate, which is an interesting group of an interesting publication that comes out with some of the top thinkers across a broad band of my world, global macro, from politics to pure economics to there's a lot of people who write there, not necessarily always what I consider high quality because it's just they're too prolific. You can't write too much. But there were 3 or 4 articles talking about how the dollar, you don't get caught in this dollar down move, that it's too sensationalized. And Barry Eichengreen, who's one of the better global macroeconomists, teaches at Berkeley, said, this is, don't get caught into that trap about the weak dollar. Now, first of all, it's only been recent in the last 3 or 4 weeks with this move that the media has picked up on the weak dollar. So they're sensationalizing it.
Yep.
It's baloney. Eichengreen is 100%. This is baloney, though. The dollar hasn't really moved. The dollar's down 3% for the year. Now it's down 10% from where we were in March when we had a shortage of dollars because of the global panic that pursued. And we saw the gold get hammered. We saw the dollar rally. We saw all those things, but that was a bad thing. And I know you and I talked about that. That dollar rally was breaking the back of the global system. And I had written in the blog that they should open up swap lines, cut interest rates. This is before the Fed even did it because they had to relieve that pressure. And once the Fed went that route, not that they needed my advice, that was just the policy tools that they had available, it eased the dollar shortage. So now we've corrected off there, but I know, you and I have to look at mean reversion trades. The dollar is nothing. It's nothing. It's against the euro. It's dropped 10%, but there's a couple of reasons for that. Number one, of course, because what the Fed did. Number two is what I call the Schweible pivot of May 24th and 25th. So there was reason, and the euro has absolutely performed to that level. But if I tell you, with the euro right now, which is trading at 118.30, if it went to 125, that's only the 200-month moving average. So on a mean reversion basis, over a long period of time, we are nowhere. This is nothing. In 2008, when the great financial crisis was taking place and the Europeans didn't seem to be as affected, and U.S. Bernanke was pushing rates lower, we hadn't even started on QE yet. The euro ran up to 160. So where are we? Nowhere. This is so negligible, but it's important for the global financial system. The global financial system, forget about trade issues. From a financial standpoint, that's been my argument, needs a weaker dollar to relieve, first of all, to get commodity prices up, to relieve some of the debt stress on the emerging markets, currencies especially. So this is a good thing. And you know what? We'll bleed into the equity markets because the equity markets sense that and are doing exactly what they should be doing. A weak dollar in the short to near term will aid and abet the stock markets.
Let's stay with the stock market. As you know, I trade the E-mini S&P primarily, a little Russell and 10-year. And 10-year is something that you and I, let's face it, last year we used to talk about it all the time. This year, up until really the past couple of weeks, I set alerts. I finally started to get some alerts on the 10-year, and I've been really focusing a little bit back more on that now than the S&P because all-time highs in stocks never been my favorite market to trade. But 10-year, 30-year, starting to move a little bit right now. What are you seeing in those markets?
Well, that's what we've seen for the last couple of days because markets are going to try to push the Fed here to find out how the Fed's going to react. Okay, the same time this is doing this, Mnuchin last Thursday, Friday, previous week, talked about that the Treasury was going to try to extend out their duration. Right now, they've been pumping all their money raising, all the debt that they've been selling has been in the short end for the most part, relative to the long end. This week we had a 3, a 10, and a 30-year auction, I believe. The 30-year yesterday was dismal. So the market's saying, hey, you might have a little bit too much inflation there. So we're going to push a little bit. Or some people are actually saying, well, this is not a one-way bet anymore, and maybe I should start hedging myself. So we've seen some selling this week, and we've actually done some technical damage to the 30 more than the 10.
Yeah.
10 is kind of putting in here. But the Fed has over and over and over for the last 3 months talked about yield curve control. Now, I think I was on with you after that one weekend where Lael Brainerd talked about it. And I said, I'm getting out of, because I had steepeners on that were starting to do pretty well back in May, meaning that the long end was going up much more quickly than the short end because it looked like things were starting to slow down with the pandemic. And people say, oh, there's all this stuff that the Fed's did. And then all of a sudden we started getting more discussion about yield curve control, which the Fed buys out farther on the curve in an effort to keep the longer end of the curve, keep those yields from rising, because that's ultimately going to be a huge problem for the United States. It's not yet, but it will be a problem because with all this debt coming on, the cost of financing it, as long as the Fed can manipulate rates to keep them low, the cost of financing it isn't a burden. But if the long end yields start to go higher, it becomes a burden. And that only becomes important because it affects the whole budget process in the United States. If interest rates were to go up 1 full percent to 1.5%, which isn't a lot, by the way, and would take us to very negligible to still probably negative interest rates if inflation was on the rise. But it becomes a huge issue because of the huge amount of money that will have to be paid out to finance all that debt, which will then take away from all kinds of other programs, a lot of discretionary programs, which Congress loves and the White House also loves. So that's when the politics will kick in, but that's the nuance and context. Yeah, but it's at least 6 to 8 months off, I would say.
But it sounds to me as though right now you're keeping a sharp eye on the 30-year.
Oh, you have to, because where is the Fed going to start to say, okay, we're going to have to come in here? And it's more their purchases because they will impact the market. Look we go back to that famous discussion we've had, I think last August, as a matter of fact, with Kishal again, where we talked about the Widowmaker, which was the JGBs. Everybody wanted to get short the JGBs in Japan. Everybody, the best traders in the world, and nobody can make it happen. Now, there's a lot of reasons for it, but it was a losing trade, and they call it the Widowmaker because they kept coming back to take a bite. I took 1 or 2 bites at that back in the 90s, got my ass in, got beat up pretty good. And I said, okay, something else. And I learned it. And actually, the one who understood it better than anybody was Paul Krugman's work on depression economics. Really highlighted it, and you had to pay attention to him. So, are we there yet? No. But how far is the Fed going to let this go before they start talking about more yield curve control? Because if this curve starts to steepen beyond levels that they're comfortable with, that will become the next tool. And I will tell you this, if you go to yield curve control, the dollar will get hit and gold will rally.
Interesting. So that would keep those trends intact. Final question for today, Ira.
Yep.
I want to pick your brain as to what you're going to be trading. I know you already mentioned the yen, but I know you, and you're probably looking at a few other things as well. So, what markets besides the yen right now are you eyeing for some possible trade setups?
Okay. Wait, you know what? People say, I'm looking at this inflation play. Okay, because there's a big argument between people who I have great respect for, Lacey Hunt, David Rosenberg, Gary Schilling. They're in the deflation camp. I'm not there because I think, yes, we're heading that way, but that's what scares the Fed, and they're going to throw everything at it to prevent it, as will the ECB and the Bank of Japan. I don't know. I don't know what to do with them at this point in time, but they will try to prevent it, and that's what piques my interest. So, like in my personal stock portfolio, all I'm doing is buying ag stocks, mining stocks, and stocks that I think can benefit from higher prices. And again, my criterion, because I'm a top-down analyst, not a bottom-up. So I just will look at that. And then I have to put on a bottom-up hat, and I'll look to see what their debt structures are, because that's very important to me, especially in today's world. Because if interest rates were to start rising, anybody carrying too much debt is going to get crushed, which is why Lacey Hunt makes the argument that he does, because that'll prevent any real type of growth, because people will be constrained, spending constrained, because they'll have to pay off the amount of debt loads in the face of higher yields. So I'm watching this. This is what really has my interest. Right now, we're not seeing much of anything. I know I'm a little early with this, but I am looking for those types of inflation plays, which is what the dollar is to me, by the way. Because of U.S. inflation, without the Fed raising rates, then we go to greater negative real yields. Okay, so all your listeners have to understand that if interest rates are 1% and inflation is 1%, your effective real yield is zero.
Yep.
But if interest rates are 10 basis points on the front end and inflation is 1.3, your effective real yield on a 1-year T-bill is negative 1.2%. Okay, you're losing money. So this is what I'm paying attention to, and to see where this goes. Now, I know that can't change. So the only way it can change, if real yields were to go higher, is if prices actually kept dropping. Then the real yields would go higher. That's what Japan experienced in the 90s, by the way, when everybody got beat up, because everybody was thinking, oh, Japan's going to be in this inflationary spiral. Never happened, because prices were actually dropping. They had real deflation. We have yet to see deflation. We've seen some disinflation. We have not had deflation in the U.S. And I don't think that we're going to get it. Now, I'll adjust when I see certain things that tell me I'm wrong. I'll adjust. Now, I think that you saw gold get beat up this week, and it was in response to that, because two things happened. Yields on the longer end went a little higher, so the market got excited. And the inverse of that was what bank stocks did, right? We had a little bit of steepening in the curve, and this was a very good week for the financial stocks, bank stocks especially, because they're looking at the curve. Well, the curve's, I think that relationship is a very nebulous one until you really get a significant move. Okay, 6, 7, 8 basis points is insignificant, but the algos drive it. So that's part and parcel. But now the banks have kind of settled in, because everybody else realized, it's no big deal. So we are going to watch that, and I'm going to be very attuned. As we're talking right now, the yen's making highs, by the way. Just, you've been very good for this trade. Thank you very much, Anthony. I doff my cap to you, sir. No, but these are the things that are, and if we get that inflation, then I become even more negative on the dollar. So can we go back to 82 to 83 in the dollar index? Yes. Can we? I think a big tell will be what happens if the euro gets to 125. That's a big area because that's where it failed from last time. Let's see what happens. But that'll be predicated upon, again, real yields going ever more negative. That's what I'm watching.
Yeah. It really just gets me thinking as to a lot of the things you talked about and why gold pulled back a little bit. And when you have a crowded trade out there like gold is, and I'm somebody who's been bullish and I'm not trading it, but it's so sensitive to anything to pull it back that you get a lot of people that pull it out. And I'm going to take a look at it on my charts this week. I've actually been waiting for a pullback, maybe even to step in on a swing position in gold. But everything you said today, Ira, thank you again so much. I've learned so much from you about context and nuance. You're the best, my friend. Thank you so much for joining me.
Anthony, thank you very much. And please lend me some of that hair, will you? Thank you.
You're the best.
Thanks,
Hang tight, traders. I'll be right back with my final thoughts.
24/7 access to diverse global markets. Right here.
That's why I added stock index futures to my trading strategy. Now when I see ups and downs coming, I'm ready.
Well played.
Why trade futures with TradeStation? You can trade over 80 products, from home, work, or on the go, with a powerful, easy-to-use interface and prices that let you focus on padding your wallet, not emptying it. Upgrade your trade at TradeStation.com.
Final thoughts for today, traders. Context and nuance. No one has taught me more about context and nuance than Ira. And as a day trader, discretionary day trader, like many of you are, I think it's so important to spend more time studying context and nuance to help us with our edges. Now, let's take a look at the charts. In this show today, I talked about how I'm looking at a gold swing position, and I mentioned that I'll be using micros. Why will I be using micros? Well, because the area of execution is very wide for this long setup, this swing trade. And I don't want to be, get caught with too big of a position on with a bigger contract and get stopped out. I want to be able to hold this position because my targets are very wide and very far, and it might take a long time to get there. And I want to be able to scale in and scale out of this position. So the micros are a better fit for me for this type of swing position. Now, I also want to mention, why am I looking at a gold swing position? Everybody knows most of the time I'm trading the S&P, Russell, or 10-year. Well, because some of my favorite trade setups come from when we have a primary trend, like gold has to the upside, and you get news or something that pulls us back into trend, like Ira talked about this week. There were some things that came out as to reasons why he felt gold was a little sensitive to being for a pullback. Then you get the pullback, and then what do? You go to your strategy. You all know that I love Bollinger Bands. My strategy is based off of using Bollinger Bands. You could download my indicators for free at anthonycrudele.com. And I talk a lot about how when the market's going in one direction, like gold has been going up, and the top Bollinger Band is going up with it, you don't want to be short until when? Until the market, the Bollinger Band start to come back in. We saw that, and then look, boom, and then you could see my levels here. And then that's something that I feel like the market is boxed in. But why am I looking long is because we hit a primary trend and then the market pulled back into it. And now I have my support and resistance levels and I can manage my risk better. Here we were just breaking out in gold, a little harder to manage risk. Now that I have some levels, I'm a little bit easier to be able to step in and have a range of execution and manage risk. I also put a moving average in there. 1858 roughly is the gold continuation moving average, simple 50-day moving average. Why am I using that? Not to trade. I'm using it simply because I want to see if it's confirming any of my support and resistance levels. And it is coming in just above my light blue, which is 1828, and really 70 points below my orange. So now I have a boxed in level of range of execution. And that's really going to come down to 1928 to 1828, and 1858 is a confirmation. My target's going to be 2029 and then 2180. So for me, anything down below Now that I've seen the market stabilize a little bit around my orange of 1928, I'll probably pull up some 60-minute charts and look for some levels, anything below 1928 down to 1858, and maybe even we get a little squirt down to 1828. Those are areas that I'm looking to be get in, and then looking for scales all the way up. This is another reason why I like the micros, because I could put risk on, take risk off, and really just scale in and scale out of this position. And what do I always say? Where are you wrong, right? Where am I wrong? I would really like to see a daily close below 1828 is where it would tell me I'm wrong, but I'm going to work some hard stops, probably 10 points below there, maybe 1820, 1818, just in case something happens. I wouldn't want to get out because I think that if that does happen, I'll watch for the daily close. If it were to close back above it, I'd probably just get back in, but work some hard stops in there. And that's my process for looking for a long gold swing position. Now, remember, everybody, it's not about telling you what to think, it's teaching you how I think. And if you have any questions or comments, please put them down below. And you could also follow me on Twitter at Anthony Crudele. And don't forget to check out Instagram, doing a bunch of different things that I'm not doing on Twitter, on Instagram at Anthony C. Crudele. That's a wrap for today. See you next week.